Since swing points are interconnected with support and resistance concepts, we can return back to the previous case study and see how support can be defined as areas on the chart where falling price is likely to be opposed and the opportunity for an upswing becomes more likely. The market can continue falling below a support, such as what was seen going under 55. However, there will often be a minor delay, and if it is a very strong downtrend, such as what was seen going below 52, there is likely to be strong bearish price action, a steep descent, accompanied with high red bearish volume. And the reverse applies for resistance that offers opposition to rising price and the increased opportunity for downswings. And resistance can be surpassed, especially during strong uptrends, because green bullish price action and volume at consistent and or exceedingly high levels are more than enough to surpass a resistance, provided selling pressure has adequately subsided. And even if there are no downward reversals, there are likely to be at least temporary areas where price remains relatively flat at resistance prior to moving higher. Support and resistance can be identified quite accurately without the need for any fancy tools. There simply needs to be at least one swing point to run a line through, preferably at least two or more if possible. Remember, they are just ranges where price is likely to reverse, but it is still useful to narrow down a certain price level where the range is going to center. Otherwise, if resistance and support are conceptualized as ranges that become too wide, they become less precise and not very useful. On the other hand, if they are narrowed down too much to be fixed as price levels down to the exact decimal, they become less useful as they don't take into account the dynamic developments of the market that constantly shift the exact center of attention for buyers and sellers. So on this chart of gold futures, the 1697 level from the absolute high of this downswing point can be rounded off to about 1700, and this will be the center of a range that can define a potential resistance to another uptrend. A chart of gold futures is also a good start since it provides an example where the price action can be analyzed without necessarily having readily available volume. It is overall quite simple. The range around 1700 is a very reliable resistance that later becomes a crucial support range. After this series of case studies, there will be an outline of the key characteristics that constitute good identification of support and resistance. But along the way, you'll probably notice some common features that appear. Different chart and different market, but we can see a similar story to gold futures in terms of the price action on the chart from a pair of downswing points forming resistance. Since it is a stock chart, we can also benefit from the addition of readily available volume. Continue to pay attention to the marked price levels and ranges and how the price action and volume behaves at these areas, and later on we'll return back to this and other examples to see the commonalities when identifying support and resistance to great effect. Like the gold futures chart, this Australian dollar to Japanese yen forex chart doesn't have volume displayed, but looking at the price action is more than adequate. Simply looking at swing points is more than adequate to identify reliable support and resistance. Remember, it's a search for approximate price ranges of interest, rather than looking for narrow, guaranteed levels down to the decimal point, where reversals, continuations, and breakouts are going to occur for sure. The famous case of Bitcoin will provide an interesting example, especially during the late 2017 to early 2018 period, when Bitcoin and cryptocurrencies in general entered the forefront of public attention. You may recall that historic time, sometimes referred to as the crypto crash, with large fluctuations in price. Despite this unique situation and drastic movement, there were still features of classic resistance and support that were able to be used for the identification of key areas on the chart in the long term and short term. And years later, during a drastic recovery with sharp price increases, the same few price ranges managed to hold great influence. Changing things up again, here's the SPY S&P 500 ETF. It's the ETF that tracks the S&P 500 index, and here it's in the intraday 15-minute time frame. It is a much shorter time frame than the daily charts looked at previously, each candle and volume bar representing a 15-minute span of price action rather than one whole day. It's a different situation once again, but the core features of resistance and support are still demonstrated. We also see some price gaps, which are more common in the stock market since there is higher activity of buying and selling near the open and close of each day of trading. Take note of both the price action and volume during key areas where the market is contacting, for example, support ranges and moving through resistance areas. It is also possible to see the same characteristics emerge across time frames from the shorter 15-minute time on the left and the longer term daily time frame on the right, showing the same general influences from the same price levels and ranges. Areas of contention and interest for buyers and sellers are important both in a shorter time frame and longer time frames, where certain areas on the chart will be of focus for both shorter-term traders and longer-term investors. Essentially, a summary of key areas that will be of great importance to the bulk of market participants. Now, let's review some of the common characteristics of the simple yet effective process of identifying reliable support and resistance, in case you need more detail or just an overview. One core feature is that resistance and support need to line up with at least one swing point, preferably two, and preferably ones that are more recent, because more recent swing points are likely to retain influence in the immediate future. However, it is acceptable to have only one swing point to reference a resistance or support area, especially if it's the only swing point, for example at a record high or record low price range. Single swing points can still retain great influence if they are major long-term reversal or breakout areas, but there will be a tendency for their influence to diminish as time moves on. Normally, when there are multiple swing points in close proximity and you're trying to narrow down the support or resistance range, it is often better to choose the 1 or 2 reversal areas that have produced the largest reversals. There could be more, but it's a choice between the swing points producing the larger reversals or the ones that are more recent. Optimally, the largest reversals would also be the most recent ones. However, that may not always be the case. Sharper reversals, those being areas on the chart where the market reverses faster and with little to no delay. But again, this may not always be possible. And that is where the element of practice and skill is developed to balance between the influence of more recent swing points, sharper swing points, and those that produce the largest reversals. All three features won't always be present, and there will have to be some compromise of features that are included for swing points that narrow down the resistance and support ranges. If the resistance or support can't be narrowed down to a more central price level, it is useful to widen this into a support or resistance range. But be careful to not make the range too wide or it becomes too imprecise. Again, it is somewhat of a balancing act between narrow precision and trying to incorporate the realistic concentration of interest for the bulk of market participants looking to buy and sell. Bitcoin is a great example because it is a classic case of very wide ranges in price. Also, when possible, round off price levels to end in 0 or 5. These are nice, neat psychological numbers. The more rounded a number is, the clearer it is to notice for more market participants, and it is more likely to become a focal point of interest in a particular price range. It's not absolutely necessary in all cases, but it just makes for a neater chart. Using less rounded or even unrounded numbers is possible, but everybody just prefers a much cleaner chart at round numbers. There can often be large amounts of volume at support and resistance areas, especially when they form key swing points, and this is also true for when a particular area is strongly surpassed, such as with the Zoom case. This also applies to a strong downtrend. There can often be large amounts of volume at important swing points, which form key support and resistance ranges, along with large movements in price. This also applies to when there is a strong breakout, such as when Zoom broke out to new record highs. This could also apply when a chart is breaking to new record lows. And if there is no volume, such as on a Forex chart, you can still look at the price action to see steep movements. Support and resistance areas are no guarantees of price reversals. They are just areas where price is more likely to reverse, and that is demonstrated very clearly with the Zoom chart example. The area around the 160s was a very clear resistance, and the market temporarily moved above it on multiple occasions, even when there was very clear resistance at the time. The temporary penetration of these ranges is very natural, especially when there are large increases in volume and steep price action. The faster a market is able to close over a resistance or below a support, the more likely it is to cross into new territory. But if this does not happen, and the market begins closing at or under resistance or at or above support, a reversal is more likely. This was very clear with the Bitcoin case. Price was closing at or slightly above support with the minor upswings, at or slightly below resistance for the minor downswings, and when there was the decisive break to newer lows, there was strong closing under the developing support, and later on, the market had difficulty to close back into the prior support range. And during the delay before and sometimes after a break of a support or resistance level, there may be a decrease in drastic price action and quantities of volume. And even if a support or resistance doesn't produce a swing point and is crossed with strong price action and increasing volume, there may still be a minor delay when the market contacts these areas, such as when Bitcoin was delayed near the breaking points of support. The validity of support and resistance areas can be bolstered when they are applicable across multiple time frames, such as what was seen with the S&P 500 ETF example. Sometimes a range can be so strong the market begins to slow down before direct contact with the focal point of the range. It's almost like a magnet repelling prior to direct contact. And already covered in the last section on swing points, support and resistance areas can be passed, of course, with large spikes in volume and price action. However, they can also be passed with consistency and not necessarily exceedingly high levels of volume and drastic price action. And if they are charts such as gold futures, or if it is a forex chart such as the Australian dollar to Japanese yen, the same general observation can still be made. Certain ranges of support and resistance can still be passed with consistency in the price action, consistent rows of red candles for a downtrend breaking through support, and consistent rows of green candles moving over a resistance range. These have been the simple yet effective techniques for identifying reliable resistance and support. This foundation is essentially all that is needed. Everything else in technical analysis traces its roots to these basic principles, such as the use of Fibonacci ratios or the application of indicators.